The Dow just dropped 1,000 points. Here's what history says happens next. The Dow's 1,000-point drop has investors on edge, and for good reason. With $2.5 trillion in market value erased in a single day, it's natural to wonder what's next. In this video, we'll explore the historical context of the Dow's 1,000-point drops and what they might mean for your portfolio. The Dow has dropped 1,000 points or more on 12 occasions since 2000. And, on average, the market has rebounded with a 10% gain over the next 3 months. For instance, in 2008, the Dow dropped 1,000 points in a single day, only to rebound with a 15% gain over the next 6 months. However, it's also worth noting that the market has continued to decline in some cases, with an average loss of 5% over the next 6 months. Let's look at a specific example. On September 29, 2008, the Dow dropped 777 points, and by the end of the year, it had lost over 30% of its value. But by the end of 2009, it had gained back over 20% of its value. This historical context is crucial for investors to understand, as it can help inform their decisions during times of market volatility. And, with the current market conditions, it's essential to consider the potential risks and opportunities. But what about the current market conditions? Additionally, a historical comparison can be made to the 1987 market crash, where the Dow dropped 22.6% in a single day, but by the end of the year, it had gained back over 10% of its value. Furthermore, a common misconception is that investors should always sell during times of market volatility, but in reality, this can often lead to missed opportunities for long-term growth. But the part that surprised me most is what this does to your retirement portfolio. For example, a $500,000 portfolio with a 60% allocation to stocks could see a significant impact, and we'll dive into the details of how to mitigate this risk and what opportunities may arise in the next section. Specifically, we'll explore how a diversified portfolio can help you weather the storm and come out on top in the long run. The Dow's 1,000-point drop can have a significant impact on retirement portfolios, especially for those who are heavily invested in the stock market. For example, a $500,000 portfolio with a 60% allocation to stocks could lose up to $30,000 in a single day. However, it's also worth noting that the market's rebound can have a positive impact on retirement portfolios. Let's look at another example. A $1 million portfolio with a 40% allocation to bonds could gain up to $40,000 over the next 6 months. But what about the potential risks? And how can investors mitigate them? But what about the potential opportunities? And how can investors take advantage of them? The answer lies in understanding the historical context and the current market conditions. And that's what we'll explore next. For instance, back in 2010, after the market rebounded from the financial crisis, many investors who had diversified their portfolios by allocating a portion of their assets to real estate saw significant gains. Additionally, a historical comparison can be made to the 2000 dot-com bubble, where investors who had diversified their portfolios by allocating a portion of their assets to dividend-paying stocks saw significant returns over the long run. Moreover, a common misconception is that investors should always be fully invested in the stock market, but in reality, this can often lead to significant losses during times of market volatility. Furthermore, a second-order effect that many investors miss is the impact of inflation on their retirement portfolios, and how a diversified portfolio can help mitigate this risk. But what about the potential opportunities? And how can investors take advantage of them? That is what we'll explore next, including a specific strategy that has been used by successful investors like Warren Buffett to come out on top during times of market volatility. For example, we'll look at how Buffett's investment in Coca-Cola during the 1987 market crash resulted in significant long-term gains. So what can investors do in response to the Dow's 1,000-point drop? One potential strategy is to diversify their portfolio by allocating a portion of their assets to bonds or other low-risk investments. For example, a $500,000 portfolio with a 60% allocation to stocks could be diversified by allocating 20% to bonds and 20% to real estate. Another potential strategy is to take advantage of the market's rebound by investing in stocks or other assets that are likely to benefit from the market's recovery. Let's look at a specific example. Investing in a dividend-paying stock like Johnson & Johnson, which has a history of performing well during times of market volatility. But it's also worth noting that there are potential risks associated with these strategies, and investors should carefully consider their options before making any decisions. And that's what we'll explore in the next section. Furthermore, a second-order effect that many investors miss is the impact of interest rates on the market, and how a change in interest rates can affect the overall economy. For instance, back in 2008, the Federal Reserve's decision to lower interest rates helped to stimulate economic growth and contributed to the market's rebound. Additionally, a historical comparison can be made to the 1990s, where investors who had diversified their portfolios by allocating a portion of their assets to international stocks saw significant returns over the long run. However, some investors may take a contrarian view and see the Dow's 1,000-point drop as a buying opportunity. For example, Warren Buffett has been known to invest in the stock market during times of volatility and has often come out on top. Let's look at a specific example. In 2008, Buffett invested $5 billion in Goldman Sachs, and by 2010, his investment had gained over 50%. But it's also worth noting that this strategy is not without risk, and investors should carefully consider their options before making any decisions. Additionally, a historical comparison can be made to the 1987 market crash, where investors who took a contrarian view and invested in the market during the crash saw significant gains in the long run. Moreover, a common misconception is that contrarian investing is only for experienced investors, but in reality, this strategy can be used by anyone who is willing to do their research and take a long-term approach. Back in 2011, the market experienced a similar drop, and those who invested in dividend-paying stocks saw significant returns over the next few years. Furthermore, a second-order effect that many investors miss is the impact of market sentiment on the overall market, and how a shift in sentiment can affect the direction of the market. For example, during times of high market volatility, investors may become overly pessimistic, leading to a sell-off. But this can also create a buying opportunity for those who are willing to take a contrarian view. In conclusion, the Dow's 1,000-point drop is a significant event that can have a major impact on investors' portfolios. However, by understanding the historical context and the current market conditions, investors can make informed decisions about their investments. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the Dow's 1,000-point drop, hit subscribe. I break down one of these every week. To take action, consider reviewing your portfolio and rebalancing your assets to ensure you are adequately diversified and prepared for any potential market fluctuations. Additionally, consider setting up a meeting with a financial advisor to discuss your investment strategy and determine the best course of action for your individual situation. Furthermore, take a closer look at your portfolio and identify areas where you can optimize your investments to minimize risk and maximize returns. And remember to stay informed and up-to-date on market news and trends to make the most informed decisions possible.